Right, welcome to Growing Tech with Greg Williamson and Owen Scott. Today we're lucky enough to have Tim Wixon, who's Head of Technology Industries at Bank of New Zealand. We're going to talk to Tim a bit about his background and how he got into this world of tech and the banking sector, and a little bit around raising capital, financing your tech business. So welcome along, Tim. Great to have you here with the podcast today, and I'll hand to Owen to open up.
Yep. Hello, Tim. I suppose just to start with, we're going to go back in time and understand you've got a history. You've got a history in corporate financial services and securities law. So how and why did you become involved in the tech sector?
Yeah, great. So thanks for having me. I did have an early career in securities law. Found out pretty early on that that wasn't for me, and my first baby step out of securities law was quasi-securities law. So I stepped into the Financial Markets Authority for a year or so in 2014 when there was a whole range of interesting IPOs on the NZX. So a couple of household names like Mighty River Power, Meridian Energy and Genesis Energy that was sold down by the National Party, and then a whole raft of tech companies, so Gentrack, IK, GPS, Serco, Vista Group, and a range of others. So as I started to get further out of law and into the wonderful world of financing at a bank, when I turned up here, I had that predisposition of a year of looking at interesting companies and how they make money, and I kind of got captured with the recurring revenue type models and underlying unit economics, etc. And as I was handed a portfolio of clients at BNZ, there was a drive to specialise or focus on certain industries. And being the new kid on the block, there were 7 more senior bankers that got to choose all of the easy ones to bank. And I put my hand up and said I was going to do tech, and everyone kind of gave me a funny look and a bit of laughter. But so which made me think I'd double down on it, and it turned out actually that you can fund tech companies. So got the interesting opportunity to have a little bit of the background that I had from securities law and Financial Markets Authority and kind of apply it in a bank construct. So, and here we are, sort of 7 or 8, 9 years on.
Yeah, great. And it's, I mean, interesting today, traditionally tech businesses, you talk about them funding through equity, through the family, friends and fools sort of model of finding cash to grow, and not so much looking at the bank financing. Is that changing as the market's sort of maturing and the product's getting more diverse? What's happening there?
Exactly. So I mean, before I started here, the tech and funding and banking wasn't even a thing, and not long before that, there wasn't a whole bunch of depth to the equity markets either, right? So hence a whole range of companies going IPO in 2014, which is only 8 or 9 years ago, in terms of their capital pathways. So for sure, I mean, banking's a pretty mature and traditional style of business model. They've been around for a little while, and certainly before the age of the internet and software and some of the interesting tech companies that are around now. So from a bank perspective, it's been a bit of a paradigm shift to go from, security-led and assets that you can see, feel and touch to assets that you can't see, feel and touch, and then even if you're looking at the cash flow drivers of tech companies, they look a little bit different often than what you might have looked from a more traditional company as well. So that's evolved a ton. So even in our world, we've gone from 5 or 6 dozen high-tech manufacturers and a few perpetual license software models, which was what was around 8 years ago, to 1,500 or so tech companies across software and software enabled and high-tech manufacturing, even some biotech, and I guess we're seeing that growth again of that high-tech manufacturing, hardware, deep tech kind of market as well. So a huge amount of change, but yeah, I mean, we weren't there, right, 8 years ago. Now we are. There's a whole fragmented range of different capital options as well. So venture debt, traditional bank debt, different forms of equity around global and domestic capital. So things have changed a lot over, especially the last 4, 5, 6 years. And so I think that's kind of changed. So the availability of different forms of capitals there, and now there's a little bit of education around what's available for founders and executive teams. So beyond just family, friends, fools, beyond just bootstrapping, although sales, in my view, is still the best form of financing companies, followed closely by probably grants or debt, and then maybe equity after, as a biased view. and then I think the other dynamic that's changed is just there's been a flood of equity, then there's been an equity market kind of shift. So, it's well publicised that valuations have been down in global markets and equity markets, etc. So I think you've also got a dynamic now where founders and executive teams and boards are a little bit more circumspect and think a little bit more broadly around capital options as well. So I think, there's lots of options out there, and it's really changed.
Yeah, I was going to sort of ask you about that just, I suppose, digging into the same topic a little bit, is whenever we sort of talk to founders, you talk about, funding, it's always about, like venture capitalists and this sort of whole world. Like, are people aware that banks are now an option?
Yeah, it's a great question. So we have been slowly but surely chipping away, but it's not particularly overt. So I wouldn't say that banks and marketing and storytelling around what we get up to is particularly well done either. But also the really interesting high risk capital goes in from equity or angel investors or venture capital, and they're responsible for building a lot of companies that are our clients as well, or our clients later. And we're a different source of capital, right? So the context that a bank plays in is risk. The context that angel and venture capital plays in is probably a little bit more towards uncertainty. So if I frame those two things up, we like a context where things are, or the future or outcomes or business model and where things are going are predictable and measurable, and there's some past information to give us a bit of qualification of what the future might hold. Whereas that uncertainty context, which is not our space, is where things are unmeasurable and unpredictable, and there's not a lot of past information to qualify potential outcomes. And so sort of horses for courses in terms of capital structure, but particularly complementary, right, in terms of debt and equity becomes a pretty good mix. Of our client base, 80-90% of them, even a year ago, would be bootstrap companies that are family owned, started with some friends, families, fools, as you put it, Greg, and then scaled from sales and drip fed a little bit of debt in over time. So there's definitely two different sides to the market in terms of how those things play out, and then a lot of blending in the middle is particularly, and including those sources of capital have become more familiar with how they interplay as well, and the providers thereof.
Yeah, and you guys are obviously trying to innovate in this area a little bit too. I mean, you've had this project scale up for SaaS businesses. You want to tell us a bit more about that and what you're trying to achieve with that? I think it's you've started into that, have you?
Yeah, so I guess start point context is banks prefer profitable tech companies as a start point, and the majority of our portfolios have been profitable companies, and then we've dipped into that pre-profit type of company from time to time on an ad hoc basis, and we've certainly done plenty over the years, and some of the big household name tech companies as well, right? So what that's meant is that it was precluding a range of those companies that we just spoke about, which were venture capital backed and are scaling a bit faster. And so we've launched two offerings for two purposes, but both of them, revenue-based financing and project scale-up, are our first ever two explicit bank mandates to go into pre-profit companies. And they're for tech, which is awesome. And they're designed slightly differently. So I'll frame up both just really quickly. So revenue-based finance is just for business-to-business software as a service companies. And we start at $500,000 of recurring revenue, and we fund up to 33% of that recurring revenue. And that's generally or often when venture capital gets interested as well, just to frame up the timing of that. And historically, we've been more interested in companies at maybe 2.5, 3, 4, 5 million turnover plus. So it's our enabler to go pre-profit, but also to go way earlier when the money might matter a bit more, even if it's smaller quantums from our perspective. And then Project Scale Up was an initiative for, okay, well, there's also these really high quality companies at that 5 to 50 million turnover bracket that are scaling really quickly. And we also can't hang on to those or be that helpful from a capital perspective with those companies all the time. And so we've launched that. It's a portfolio for 15 or 20 of the highest potential, highest growth tech companies in the market. Any business model, so not just SaaS, any tech business model. And the idea is to put in growth capital and put a growth panel around on an opt-in basis for those companies. So The capital looks like somewhere between 5 and 50 million of non-dilutive debt capital. Hopefully it sharpens up a bit of the private equity market or as a complement to them as well. And then to add on, so you don't miss out on some of the smarts that come potentially with some of the equity providers, to pull together a voluntary panel of mentors, 3, 4 or 5 strong, that match off against the 3, 4 or 5 key constraints, dependencies, opportunities for those companies in the portfolio to scale. And those personalities would pull in from our founder, ex-founder, professional and advisor type networks that we hold as a bank. So that's the premise of that. And then we're starting to look at some other opportunities in the climate and clean tech space and a few other areas where we might be able to do a bit more.
Okay, no, thanks for that, Tim. That's pretty exciting, that one. So I suppose just leading, you starting to sort of talk about this at the end, but I suppose just a question around, what other initiatives is the BNZ offering for the tech sector? And I suppose, is there anything that's more than capital? And I suppose also just a little bit about, is BNZ sort of alone on this, or are other banks offering these sorts of services and initiatives as well?
I'll start with the last part of your question and then we'll go back. We would welcome seeing more activity from all the banks in this space. There's also a huge amount of non-dilutive capital that's available outside of the banks, and we spend quite a bit of time competing in global banking and venture debt and capital markets as well. So we would see the likes of a Silicon Valley bank as often as we might see a local bank in terms of funding tech companies. Kind of interesting, and competed against the likes of Amazon even 6, 7, 8 years ago for working capital facilities. So it's a lot more fragmented and complex in terms of who the capital providers are out there, outside of just main banks as well. In terms of the non-capital stuff, so we're aware that businesses expect us to provide capital, and so we've spent a lot of time trying to work out how we can play earlier, right? So that we've covered that off. The best clients, the clients that utilize us best, also lean on, and it's part of our value proposition, our connections and our capability. So I'll start on the connections piece. Banks have huge networks, both domestically, globally, and in the public service or government or semi-government area as well. So we spend a lot of time plugging our clients into potential clients, advisors, potential directors, supporting them with the likes of New Zealand Trade and Enterprise, who do an awesome job of the global piece, given we're a domestic bank, and they have a global team that can help companies up into offshore markets, for examples. And then also just the observation point that we have, if you think about the capability and connections crossover, got a portfolio of 1,500 companies, and then tens of thousands of 1,500 tech companies with funding, then tens of thousands of business clients in all manner of different industries. So a lot of our clients that use us the best, again, lean on us for macro trends, how we're seeing foreign exchange rates, what do we see other businesses do well or not do well, soundboarding, get us around the table at board meetings to work out where we see risk, and treat us like a kind of a key stakeholder as we tend to be. And so there's quite a lot in that actually to unpick. And then the other side of things that we do is we're pretty keen, and this is in the wider growth sectors team that I play in. We've got a head of private capital that introduces non-BNZ capital to our client base, which is quite interesting. We do a scholarships program to help founders and their teams to upskill in areas where they may perceive that they want to learn more. So there's the likes of the ICE House Owner Manager program, but then also sales strategy and core strategy, might be something in the intangible asset space or whatever it may be. And so those are a few of the things in our toolkit, if you like. But we're always keen to be supportive and engaged. So the more proactive clients are, the more proactive we tend to be in return.
Yeah, I mean, it certainly sounds like you're sort of all in, committed, which is fantastic to the sector. I mean, I suppose switch gears a little bit. I mean, you're talking to a lot of tech businesses all the time, and when it comes to talking about them financing their growth, are there any common misunderstandings, misconceptions that they have? Because they're typically coming from more of a technical background or a pure commercial background, and won't necessarily have a lot of depth around the financing side. What are there recurring things that you'd wish people thought about, or they misunderstood?
Yeah, it's a big question. Thanks, Greg. It's so I think raising, I'm glad I don't have to do it. I'm happy to be on the other side of the table. Looks incredibly difficult. So I think the first one is underestimating how much time and how many people you need to talk to is the first key one. And I think the second one is underestimating how useful it is to build relationships early. So thinking about, and it's probably be the top piece of advice as well, right? Think about the next few lots of capital that you might need, who you might need them from, and having those relationships early rather than, and it's always better if you're in a position of strength than a position of weakness and desperate for capital. And I think that context, if I just pick on that, has changed as well. There's a hell of a lot more capital available for companies, and I think companies and founders can be pretty choosy around where they take capital from now, and that hasn't always been the case. And so I think the other key misconception is how much negotiating power or strength of position companies now have, I think is probably misunderstood or underestimated at the moment still, and I think that's a pretty big one.
You mean they misunderstand their own power in the transaction?
Yeah, so I think the dynamic, in my view, and it's just one, has gone from an abundance of startups and scale-up companies and not that much capital to choose from to an abundance of capital and the same amount of really high-quality startups and scale-up companies. And so those startup and scale-up companies now have choice, I think, and it's not just local, it's local and global in terms of where they take capital from. And so I think that just that bargaining position or start point, if you start with that framing and lens, could be pretty powerful to then think about, okay, cool, it's worth chatting to a whole range of these different potential sources of capital, and it may be, again, going venture debt or venture capital or bank or whoever it is, and just working through and then thinking about how to stack that all together. But again, it's usually time consuming, right?
Greg and I have been in the tech industry for a long time, and that's a big change in our career or lifetimes. That abundance of capital, like that was never ever a thing back in the day. So looking at that sort of same group of tech companies, what do you see as their biggest mistakes, when it comes to financing? What are they doing? What's the common things people get wrong?
Yeah, it's a good question as well. I'll rattle off a couple of examples that we've seen, and I think it's getting better all the time as well. So a lot of the observation point we have is things that have perhaps gone wrong and not been noticed or realised until quite a lot later. So, over dilution of founders, big one. So which has stunted follow-on capital. If you're going down that equity raise pathway, taking the capital that's available rather than getting the right fit. So most things we've seen break down because of relationships, and they're pretty tricky and uncomfortable, and they can end companies earlier than they should as well. And we've seen quite a lot of that. And again, it's usually 3, 4, 5 years down the track. And then the other big one, which is quite easy to solve, is just the housekeeping side of things. So not having mechanics and shareholder agreements, etc., to unwind things, dispute resolution, signing up to poor terms and equity investment rounds, which bite in later. So those sort of easy things that you can actually solve. And I guess if I bundle those all up, the key mistake is not getting advice at the right time early enough from those lawyers, accountants, whoever it is, board advisors, whoever you need to, other founders, to just understand that, and then also doing the character, so understand the mechanical stuff, and then doing your homework on the character piece. So those two tend to be the biggest things that we see, and it's unfortunately pretty regularly, but I think it's also getting better as well, as there's been more sources of capital available and more options.
Well, we're almost to the end of our time. I mean, I think it'd be really good to finish with you've probably given a heap of advice, but if you boiled it down to sort of one thing, if a founder is contemplating their financing plans right now, what would you put at the top of your list in terms of what they should think about? Should they just go and get advice? Is that the best place to start, given that it's a complex area and there's a lot more to it than often you know, an engineering focused founder may anticipate?
Yeah, so I think I might give you three things, but the top one's actually just that long-term piece. So thinking long-term about how much capital your business requires over the lifetime of how long you want to be involved in it, super important. And then working backwards to where you are now and what sources of capital you need between now and I guess what you might call completion or exit or transfer of ownership or whatever ends up being the final goal. And I think that's super important because that dictates what you might do in the meantime. And then coupled with that, two things that sit under it are, getting the right advice to help with that piece. And if you don't have the financial capability yourself, then getting someone to help with that, offloading some of that responsibility or burden or whatever you might think of it as. And that could be done in quite a few ways, right? Like that could be getting an investment banker type or a CFO in that's been there and done it. It could be that you do that in terms of a board appointment, so filling a gap in your board or advisory board that's got the financial capability and connections around capital. But one of those useful things is just getting people that have done it before that know the capital markets and what options are available so that you can have them help advise around that capital pathway that you need for your business and thinking about that earlier than later, super important.
And just one other thing, I suppose, because there's a lot of really useful information here, and you know, if somebody wanted to find out a bit more about some of the B and Z offerings you've talked about specifically, where's the sort of best place? We'll put links in our notes for this podcast, but is there just go on the website and find a spot? What's the easiest place to find some background? If you go to a bank website, it's not always easy to find that. So
yeah, so open door policy from my perspective. So just reach out. We can send my email and mobile number, and I promise to get back within a week or so at worst. Hopefully a bit sooner than that, within a day or so. And we have a network of relationship bankers that focus on tech companies throughout the country as well, from North and down to Invercargill. So if you have a local connection into BNZ, then they'll know how to find the right person, people, information, etc. as well. So website's a bit of a front of house, definitely, as I said earlier, relationship game. So doors always open, and we do a lot of that sort of stuff day to day.
So that brings us to the end of the interview with Tim. That was really good, Tim. I think a couple of things that were really insightful for me was it was really around the maturity of the market now, and you're saying how much sort of capital is available and how the founders were not necessarily taking advantage of the little shift in power. Normally you go onto the bank and you drag yourself along and you're pleading for money, possibly because they do it too late. But that was a really insight. They're not necessarily taking advantage of that. That was really cool. So thank you very much for your time. We'll put your name and pass those contact numbers on to all the podcast viewers.
Thanks very much. I appreciate you having me on.
Great. Well, that was a really good conversation with Tim Wixon from BNZ. Pretty exciting to see how committed they are to the tech sector, actually. Owen, what did you take out of that conversation?
A couple of things, really. One that we sort of talked about during the interview was the maturity or the change in the capital scene in the tech sector. It wasn't that long ago when it was just a given that there was no capital. That's just everyone. That was sort of a rule. Whereas now they're sort of saying there's an abundance of capital, and almost so much that banks are getting involved, and there's a bit of a power shift that actually founders have a bit of a say in the matter about, they need to go through a process to figure out where they get the capital from. They've got choice. And I think the other thing was when he talked about some of the things you should do as a founder, getting organised, is that long-term plan, and then working backwards about what all the different stages your business would be at and what all the different types of funding that it requires. So it's sort of like you've got a bit of an eye on the future, and now you can come back, and so stage one is very planned. It's not just I need money today to do the next release of the product or something. What about you?
And the only other thing I thought really was interesting was his emphasis on the relationship side. That you need that long-term plan. You need to understand who can help you, advise you, because there's a lot of technical and financial information involved, but it's actually a lot of relationships and trust between owners, between you and the bank, between legal advisors, accounting advisors, all of that, and having that in place is actually really important rather than trying to develop it at the time that you're raising the capital.
Yeah. Okay, so thanks for watching our podcast on Growing Tech with Tim Wixon from the BNZ, and we look forward to talking to you again at our next podcast.